There is a long-standing debate as to whether we can time markets. Certainly in the short term, I think it's incredibly difficult, if not impossible. However, over the long term, the yield curve can help us better understand when credit is expected to expand or contract. Most bull markets are driven on the back of credit expansion, and therefore we might be able to understand when the best time is for longer term investing to allocate maybe a little bit more every month towards our portfolio, and of course scale back when we start to see potential credit contraction over the next couple of years. In today's video, we're going to break down the yield curve, how to understand it, and of course how credit is created. It's very important to understand how credit's created, the nuances behind it, and what the yield curve actually tell us. Let's get straight into it. So there are a couple of things that are crucial for us to understand. The first thing is, how is credit created? That's the first step of today's tutorial. The second thing we're going to look at is the different yield curves. Then we're going to look at yield curve relative to revolving credit growth, the rate of change in revolving credit growth, to look at the sort of relationship between credit expansion and contraction. And then we're going to look at some of the nuances. Right now we've got high inflation. We did have high inflation back in the 1980s. How does that impact the yield curve, and what's the signal from the noise? And then finally, at the very end, we're going to have a look at the different terms with yield curves. So we've got bull flattener, we've got bull steepener, bear steepener, and we've got a bear flattener. And we've had all of these play out over the past 15 years. So you guys will absolutely understand what all of these mean at the end of this, because it's super, super simple. So if the cycle is predominantly driven by credit, it's really important for us to understand the willingness of banks to lend and the consumer's ability and willingness to actually borrow. Otherwise, you're not going to see massive expansion in terms of credit, and a cycle grinds to a halt. So let's understand how credit is created. There's a notion out there that central banks essentially print money into existence. That's not really how it works. It's a little bit more nuanced than that. What happens is central banks mint what are known as reserves. And these reserves are useful for a couple of things. They can buy government bonds, they can buy mortgage-backed securities, and as we've seen in 2020, they went a little bit further out the risk curve. They bought high-yield corporate debt, and also TIPS, Treasury Inflation-Protected Securities. So these reserves can be used in order to purchase these. So how exactly do we see credit expand, or how do we see money expand in order to see the cycle essentially evolve? Well, deficit spending. Let's say the government brings in $100 but spends $120. That's an extra $20 going out into the economy, right? So money is expanding. There's more money, there's more growth, and the cycle starts to take off. Or it's mid-cycle and it just continues rolling. So that's one way through government spending. The other way is through commercial banks. So the central bank might mint reserves, but these reserves are used to actually control the money supply. So every loan that goes out the door has to be backed by an equal amount of reserves. Now this is one way in which central banks can essentially control the money supply. Credit is essentially created from a commercial bank's perspective out of thin air. But there are some caveats to that we need to consider. Caveat number one, banks need to be willing to lend in the first place. If they're not going to make any money on the loan, they're not going to lend out. So banks' willingness to lend is very important, and that's where the yield curve comes in as very important for us to understand where the best time to invest a lump sum of money. Secondly, customers' willingness to borrow, right? So we may be in a situation where the bank wants to lend out money, they're willing to lend, but the customers don't want it. And so there's two caveats to the commercial side. Yes, we can see reserves increase, but it doesn't necessarily mean that credit will expand. And that's where understanding the yield curve comes in, very important anyway, certainly from my perspective, when we're considering the health of the overall economy. So there are a couple of different types of yield curves. This is a very rudimentary view, but we're going to look at a steep yield curve, and this steep yield curve in red is taken from the USTreasury.gov website from the 18th of November, 1 year ago today, 2021. And as you can see, this is what's known as a steep yield curve. Short end bonds are close to zero and long end are up around 2%. That's what's known as a steep yield curve. Where we are today on the 17th of November 2022, we've got what's known as a flat yield curve. We're going to talk about what type of flattener this was towards the end, but all you need to know right now is that this is what's known as a flat yield curve. Now, what does this tell us about banks and making money on loans? Remember, consumers have to be willing to borrow, that's part of it. And secondly, banks have to be willing to lend, but they're not going to lend unless they make some money. So banks' willingness to lend is very important. How do banks make money? Historically, the reason why we would look at the yield curve is because banks would get money based on deposits, right? So based on short duration bonds, namely 1, 3, 2-year bond yield, we would understand what the cost of money was for the bank, and that would be relative to, let's say, a mortgage. So they'd be getting a yield based on the 30-year bond yield. And if this was a steep curve and you had a gap between short duration bonds and long duration bonds, the bank would make the difference here. This is what the bank would make. So if you have what's known as a steep yield curve, you make a lot of money as a bank by lending out money. If you have a flat yield curve, you don't make as much, right? And the reason why you don't make as much is because if you're borrowing on the short end and interest rates are already up close to 4% and you're only making about 4% on the long end, there is no spread there on the loan, and that's a bit of a challenge. So that's essentially how we can understand, by looking at a yield curve, banks' willingness to lend. Now don't worry about what steep is and what flat is just yet. I'm going to show you that a little bit later. But just know, when we have a very steep yield curve, banks are going to start increasing credit and we're likely starting a new cycle. So it's very important to recognize. As we go down a little bit further here, what we have is, in blue, we've got consumer loans on a year-over-year rate of change basis. So this is revolving credit, it's credit cards. Just as an example, it's credit cards, HELOC loans, etc. These are all revolving plans. And what we want to understand is, what's the rate of change in consumer loans and the relationship with the 10-year minus the 2-year bond yield. So we go back up here, we're looking at short duration bonds, and we're looking at the spread between the short and the long end. We're looking at the spread between the short and the long end to understand banks' profitability. Now, as you can see here in red, this here is the yield curve, and that red line there is 0. So when this is very high up here, that's what's known as a steep yield curve. So this was 1 year ago. That's what's known as a steep yield curve. Let me change the color so you guys can better see it. But that would be what's known as steep yield curve, steep yield curve, steep yield curve. And this would be what's known as a flat curve, and an inverted curve, where long duration bonds are below, the yield is below short duration bonds. So you're not making a lot of money there. So what we have here is, in blue, the rate of change in credit growth relative to the yield curve. And as you can see, as we get lower and lower and lower, what starts to happen to credit? It starts to roll over. Now this is rate of change. It could roll over a lot sooner, but this is based on 1 year prior. As you can see, as we go to inverted, normally we could project into the future a recession. Why? Banks are less willing to lend. Why? Because they're not making any money, and the cycle essentially will go into a recession. So there are times where we are inverted or close to inverted, and banks continue to lend. And what are those times in which that occurs? Well, this is really important because right now we're seeing historic inflation that we haven't seen in about 42 years, since the 1980s. And if we go back to the 1980s, this is very important. The yield curve goes negative on the 10-year minus the 2-year. And it stays negative for a year and a half before markets peak and roll over. And the same thing happened in the following recession. So why did we have such an inverted period? Credit continued to grow, cycle was still growing, even though the yield curve was so inverted. Well, the reason being is inflation. So inflation, if we're looking at, let's say, 30-year break-evens, we might see a much lower inflation rate. So back in the 1980s, it might be, let's say, 4% average over 30 years. That's the break-even. That's the expected inflation rate over the next 30 years. Whereas on the short end, inflation got up to about 15, 16%. So when you take 15% away from your short duration bonds, you have a very negative yield. And when you take 4% away, or whatever that 30-year average inflation is, you have a very steep yield curve, because interest rates back in the 1980s were as high as 15, 18%. Does that make sense? And so the real interest rates were impacting the yield curve back in the 1980s. The one way in which we can solve for that is take this 2-year bond yield and turn the duration down. Look at the 3-month as opposed to the 2-year. And that'll give you a better idea as to when we're potentially going into a recession as opposed to looking at the 10-year minus the 2-year. So that's a caveat. Higher inflation, bring that 2-year closer to Fed funds rate. Maybe the 3-month bond yield might make a lot more sense. So just a very quick recap. Steep yield curve, banks are more willing to lend. Doesn't mean that they will lend, but they're more willing to lend. A flat yield curve, they're not making any money on the loan because they borrow at 4%, they lend out at 4%, or slightly less in this case, and they don't make any money. So it doesn't make any sense for them to lend, so they just harvest their NII and just wait patiently until that starts to steepen again, and then the credit cycle starts again. So let's pop on over to TradingView. So TradingView, this is a charting software. These guys pretty much have a monopoly on charting software. I do have a link in the description if you guys are looking for charting software. They have a free version, so you don't necessarily need to pay for anything. So what I'm going to be using is TradingView to demonstrate this. And we're going to be looking at DGS10, which is a 10-year treasury yield, minus DGS2, which is a 2-year treasury yield. And as you can see, we can go all the way back here, and we can see those periods we were looking at a moment ago in that example. So let's have a look at the different types of curve movements. So let's start over here in 2004 all the way into 2007. This is what's known as, so we went from a steep yield curve to a flat and inverted yield curve. This is what's known as a bull flattener. Now, a bull flattener is when long-term interest rates are decreasing at a quicker pace than short-term interest rates. So you're seeing the curve flatten because long-term rates are coming down. Why would long-term rates come down? Long-term rates would come down if we have a slowdown in growth or inflation. And that's what we had in 2006. Building started to slow down in 2006, growth started to slow down, and then we started to see capital flowing to long duration bonds, the yield went down, and we had what's known as a flattener until it got inverted. Now, in 2007, 2008, we went into a recession, and out of that recession, we had what's known as a bull steepener. Now, what's a bull steepener? A bull steepener is when the short end of the curve falls at a faster pace than the long end of the curve. When does that occur? Almost exclusively during monetary easing. The central bank cut the overnight rate, in this case, to 0. And that causes the curve to steepen really aggressively. And then we start a new cycle with a very steep yield curve. So a bull steepener usually occurs coming out of a recession, and it's usually caused by monetary easing, cutting interest rates. As you can see over here, we have what's known as a bear steepener. Now this happened out of COVID, and this is what's known as a bear steepener, where long-term interest rates are increasing at a faster pace than short-term interest rates. Why? Expectations for higher inflation driving long-term rates. Go back to 2020 and listen to central bankers. Transitory inflation, that's what they told us. Turns out it wasn't so transitory, and what ended up happening was the market done their job by raising interest rates, but the Federal Reserve stayed at 0 for a much longer time. And what ended up happening is the curve steepened, because at 0% on the short end, you had the long end rising to above 2%. And that's what created a positive spread and started what's known as a bear flattener. So what's a bear flattener? Well, a bear flattener is when short-term rates rise faster than long-term rates. And this is usually caused during a hiking cycle. So this is monetary easing and this is monetary tightening. So we have these 4 different types of curves, the same curve movements: bull flattener, bull steepener, bear flattener. And what it tells us is that at the top here, banks are more willing to lend, and at the bottom, banks are less willing to lend. And that can give us an idea of the future expected growth if we start to see credit expand or credit contract. Now, as I mentioned a moment ago, there is one caveat with today, which we have to look at 1980s, and we have to factor in inflation. These are the nominal interest rates. The real interest rates are not as deeply negative. And so based on 30-year expected inflation, we may have a positive yield versus what the near-term inflation would be over the next 2 years. And so the curve could still be steep in real terms, but negative in nominal terms, and that could be driven by inflation. So again, just to recap, long-term returns are going to be a lot more favorable during a very, very steep curve. So if we get back up towards these cycle highs, you can start dollar costing average with a much bigger amount of capital into the market, because we are anticipating that the cycle is going to start roaring due to credit expansion. If you're interested, we also cover a breakdown of all three financial statements. We look at profitability metrics and efficiency metrics for businesses. Thank you very much for your support and have a great day.